And what allows you to have that kind of luxury to walk away from your clients that don't give you the kind of pricing that you want?
At the end of the day, a lot of these clients are looking for performance. A lot of them are looking for alphas. They are not looking for betas. They are not looking for just having an exposure to Asia for the sake of that exposure. They are looking for active managers who can create more values. And you have to consistently show that your performance stand out not only against the market, but key is against the peers.
Teng, some of your funds have performed very well. Looking at Morningstar again, a few of them have had 5-star Morningstar rating, but there are still quite a number of funds that either didn't get any Morningstar rating or got just average rating. Is it still justified to charge 1.8 to 2% management fees for some of these funds?
We don't really generally charge 2% for our management fees. Most of the equity funds, the fees are between 1.5 to 1.75. That's probably the max that we charge. In the past, the 1.75% could be levied because some of these funds were outsourced to external managers. One of the reasons why some of these funds are still not getting their Morningstar was because they were outsourced to external managers, and they've done so poorly. And over the years, we have taken back a lot of these funds back to restructure, to change the mandates, and to start to improve the performance. All I say is that as we took back some of these funds over the last 2 to 3 years, we have seen great improvement in those funds' performance. And I think hopefully over time, we would be able to show the ranking in the Morningstar.
You talked about being an alpha type manager, but very respected research has shown that fund managers, in fact, about 75 to 80% of the unit trust funds actually underperform the indices that they track. How do you maintain going for alpha, especially when you consider that your fund size is going to grow bigger? You mentioned a target of 50 billion ringgit.
I think in developed markets, funds tend to underperform, as you said, 75% of the time. The markets are just so efficient. You can't extract inefficiencies out of the market. But the same can't be said about developing markets. In developing markets, you really have to go to the ground. You really have to know the companies well. And there are a lot of gems to extract from the developing economies. And what we have found is that over time, over the last 20 years or so, you can definitely perform above the market and stay above the market and be able to extract significant alphas from the market if you are a manager that is diligent in your work and be actively on the ground covering the markets.
One of the arguments for your good fund performances would be the fact that some of your funds at around $50 million, it would be easy for you to buy into small caps and therefore achieve those sort of performance. But if you double your fund size and if you continue to grow from that level, will this kind of opportunities still exist?
I think the fund size does matters in terms of performance. I think you're right from that perspective. We are working out the optimal fund size for the different strategies. And my assurance to our clients is this: if we hit a limit on our strategies and that inhibits the performance of the fund, we are happy to close the fund. Hwang Investment Management will not be one to go out there to raise funds for the sake of it. At the end of the day, our clients' interest is foremost on our mind. There are certain strategies that hit a capacity. We tell ourselves, let's stop it. Let's then run another strategy. Look for other ideas. So you just need to learn to increase different asset classes within the company as you grow the size to 50 billion. Within Malaysia, maybe you hit a 5 billion Malaysian size, you're going to hit capacity. Then you have to learn to raise more Asian assets.
What is the recommendation for a fixed income investor right now, given the low yield environment, but then interest rates are also creeping up because of this tapering expectations? Then it will expose these bond funds to capital losses.
It's going to be a tough market. I think if you have invested in fixed income today, most portfolio managers would try to keep the durations as short as they could. When we say they keep the duration as short as they could, they probably still be keeping a duration of about 3 years on average.
But the yields on that would be very low, right?
The yields on that will probably be low.
How is a fixed income investor going to supplement their retirement, let's say?
And I think if you look at a very short span of time between May this year and now, definitely hasn't been an easy period for fixed income. But if actually you measure it over a much longer term, over different interest rate cycles, then you get a much more reasonable return. And that reasonable return will be in the tune of 5 to 6%. So you ask me today, if you are fixed income investors, what should you do? I think one should just ride out the volatility, just like equity markets. You go to rough patch. Today, fixed income will go to a rough patch. Tapering may happen sometime next year. It will happen. And when it happens, the 10-year treasuries will move. The interest rates in Asia will move. However, bear in mind, interest rate has moved in US 10-year treasuries from 1.6, went to about 3%, today is about 2.6. Eventually, you'll probably move to 3.5% to 4%. But as portfolio keep their duration short, bear in mind, at some point, it will reinvest because bonds will mature. By 2015, a lot of these bonds will probably be left only 1 year duration. And by the time it reinvests, that's when it will invest at a much higher level of yields. And that's where that over time, if you average out the return, you'll still be getting the 5 to 6%. But don't look at it from a short-term perspective.
So for fixed income investors, it's very important to just hold on.
Yeah, I think the key risk to fixed income other than duration risk or interest rate risk is about credit risk. In the portfolios where the credit selections have been prudent and there's no significant risk of default in the portfolio, one can ride through that volatility.
You're also a big believer of raising cash levels for funds quite often during what you think are bad times, sometimes quite aggressively to the extent of 30-40% cash levels. Do you think there is a case that these cash decisions should be made at the advisory level and not burden investors with management fees paid on cash?
At the end of the day, when you ask a retail investors what they expect out of you, they just want returns. At the end of the day, if you ride through market volatilities and be fully invested at all times, they will look at you and say, why can't you be a little bit more active and walk away when times are bad? For us, our investment philosophy is to deliver absolute return over a 3-year rolling average. I'm a big believer that in times of uncertainty, holding cash is probably the most defensive. Because when you hold cash, the value doesn't decline when markets and asset prices decline. But more importantly, it allows you to reinvest at a very attractive level when markets start to bottom out.
But the markets can go against you, right? Because we can't predict the future with certainty. And if you cash up and the market goes against you, then you would lose that returns as well.
Oh yes, I think there have been times that we are wrong. We won't say that we are right most of the time. I can give you examples that we are wrong. For instance, during 2011, during the European debt crisis, as the debt crisis developed in the month of July, August, we started to raise cash. We were holding about 30-40% cash. As it spreads from Greece, going to Portugal and whatnot, we were very cautious of the markets. Because when you look at the total debt of the whole European countries that are going to default, it really frightens you because these are talking about hundreds of billions of default. And we took on a very defensive mode. Came November, when markets started to recover, we were still very cautious. But when December came, we thought we were wrong and markets had stabilized. Yields were coming down in the PIGS countries. We quickly, rapidly reinvest. So yes, we did not catch the bottom, but that periods where we were holding cash has definitely helped the portfolio to reduce the volatility significantly. Even if I miss out the initial period where markets rebound, we're okay. We caught up eventually in the early months of 2012. So it's not easy. This is a very difficult job to try to raise cash and decide when to invest. If you ask me as a fund manager, I would love not to do it. Let you decide. But at the end of the day, is that what my investor want? At the end of the day, what my investors demand of me is that when I invest $1 with you, how much money do I get at the end of the day?
Why hasn't there been a mad scramble for the private retirement schemes, given that the government has given a $3,000 a year tax break for such schemes?
I think the scheme probably needs a lot more explaining, exposure. People need to be educated about the tax incentive. I think if you look at 3,000 tax incentive, if you look at how the tax structure of Malaysia, you realize that there are only 2 million taxpayers in Malaysia that will benefit from a 3,000 tax relief. And if you are earning 5,000 to 10,000, the benefits may not seem so prevalent to you. But I think what the PRS industry needs to move on is not just talking about the tax relief, but going out as a whole to educate the public that you need to save more to retire.
PRS schemes as well as EPF investments are kind of focused, overweighting on the Malaysian market. Shouldn't investors be given a choice to diversify more globally?
This differs from house to house. In Hwang case, our PRS, most of the growth funds and the moderate funds, the exposure are in Asian markets. Some of our competitors have stuck on to Malaysian market in their approach towards constructing the portfolios. But we took a different route. If you look at the performance of the fund when Asian markets are doing well, our funds tend to do well. Of course, after the tapering news was announced in May when Asian markets were going through that volatility, you find that our PRS also have gone through a little bit more volatility. volatility. So it all depends on the construction of the funds by the providers. And in the case of exposing our clients to Asian market, we are at the forefront of it. We believe that given the opportunity of exposing to Asia, and in Hwang's case, our PRS for the growth funds and the moderate funds has significant foreign exposure.
Now, your offerings of PRS schemes come without any sales commission, but actually is a higher than industry flat management fee of 1.8%. Doesn't this actually work out to be more expensive for investors over the long term?
It all depends on really what clients look out for. We work out our sums and we realize that if you charge a fees for retirement, then that's probably not going to be something that we believe in. We believe that as you retire, as you save for retirement, it should be as low cost as possible. The reason why 1.8% is levied on it at the moment is because the fund size are small and there are costs that we need to cover. But as we grow the fund size big, I think there's also a possibility that over time we may reduce the fees. And that's something that we are prepared to do.
Given that long-term market returns, especially let's say for the balanced investor, is around, let's say, 6%. What kind of fees do you think will be appropriate for a long-term retirement scheme?
I would think this. A balanced portfolio, a return should not be 6, but should be about 8 to 10%. That's how I would view it to start off with.
Isn't that an aggressive type of return?
No. I think if you look at our past track record, our balanced fund that we run since 2003, it has a long-term return of about 10 to 11% with a volatility of about 8 to 10% or so. My sense is that if one runs really a balanced fund, one should expect a return of 8 to 10%. And if you look at our fund guidance, we guide conservative funds 5-6%. We guide our moderate funds 7-8%. We guide our equity funds 9-10%. But when we guide those figures, we tend to be more conservative with our guidance. Our actual experience tells us otherwise.
Teng, thanks very much for joining us. It's been a pleasure speaking with you.
Thank you very much. Thank you.
That was Teng Chee, CEO of Hwang DBS on the Breakfast Grille this morning. I'm Julian Ng for BFM 89.9, the business station.